Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of March 10th. Thank you for joining us this week. Don't forget, if you find these updates helpful, to like and subscribe. Also, check out our channel, some of the other great content that we have. With that said, my goal, as always, is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as always, we'll start by looking at last week. And of course, one of the many headlines last week was tariffs. So at the beginning of last week, the Trump administration resumed tariffs on Canada and Mexico and implemented a new 10% tariff on China. All three countries retaliated in some fashion throughout the week, although by Wednesday, the Trump administration had relaxed tariffs on any goods and services related to the USMCA, or the United States-Mexico-Canada Trade Agreement, including automobiles coming from Canada. Unfortunately, this week we expect to see more tariffs. Some new ones have been threatened. Some are slated to go into effect on March 14th. And the conversation continues to evolve. Switching our focus over to the labor market, we saw private employers add 77,000 jobs in the month of February, which was less than we've added since July of 2024. We saw initial unemployment insurance claims fall back to the same level as 2024, but we saw continuing claims continue to grow. Unfortunately, it looks as though the labor market is still a tough situation for anyone currently unemployed looking to find new work. We also saw the National Unemployment Report for the month of February released at the end of the week. Although the results were a little worse than we had expected, the economy added about 150,000 jobs, which is just slightly less than the 160,000 that was expected, and unemployment ticked up to 4.1% compared to 4.0%, which was expected. Now, an important note to take away is that this data that was being reported was collected prior to February 15th, meaning that it reflects the first half of the month, but does not reflect the turmoil and all the changes that occurred in the second half of February. Most likely, what we'll see is in the March unemployment report, a lot of that February and early March turmoil is picked up in those numbers. A couple of concerning points from this unemployment report. We saw the number of jobs added in January revised down, and we saw a nearly 10% increase in the number of respondents who said that they're currently working a part-time job for economic reasons, but would prefer to be working a full-time job. This suggests that in many of the sectors of the economy currently, there is not very much room to absorb new layoffs or new workers who may have been displaced since the first half of February. This leads us to a quick conversation I want to have about the term stagflation. It's probably a term that most people haven't heard, since we really haven't experienced it since the 1970s, but it's an economic phrase used to describe a situation where both inflation and unemployment are rising or are at high levels simultaneously. In addition, during stagflation, we tend to see the economy stagnate or even shrink, as we would see in a recession. In a normal economy, we tend to see unemployment and inflation move in opposite directions. When the economy grows and unemployment falls, we tend to see inflation increase. And when the opposite happens, when the economy goes into a recession and unemployment increases, we tend to see inflation fall. Stagflation is a conflict in this relationship where we see both problems getting worse over time at the same time. This creates a problem for policymakers because most policies are aimed at fixing or addressing either unemployment or inflation. And when policymakers use their standard tools, they tend to make one better, say drop the unemployment rate by stimulating the economy, while making the other one worse, in that case being inflation, like we saw post-COVID. Now, the reality is that nobody wants to live in an economy that's experiencing stagflation, especially policymakers. Unfortunately, some of the early data that we're seeing suggests that our economy is currently slowing down, while inflation may be stagnating or even climbing as a result of the new tariffs. The latest nowcast prediction for the Q1 gross domestic product, or how much our economy produces, is actually currently predicting negative growth, meaning the economy will shrink by 2.4%. This is just a nowcast, and it's not an actual data point yet. But we do have an actual data point as far as increasing layoffs. In February, layoffs in the United States increased by 245%, according to Challenger Economic Reporting. This is the highest level of layoffs that we've seen since the COVID pandemic in 2020. Unfortunately, additionally, we also saw small businesses laying off and reducing employment for the first time since 2023. It's important to note that an economy the size of the United States tends to move slowly. So these indicators are reason to be concerned, but certainly not reason to panic. Unfortunately, as we shift our focus to the stock market, what we saw last week in the markets was the exact opposite, an excessive amount of panic. In part for good reason, the implementation of new tariffs and some concerning employment data, but also in part as an emotional response to the concern and anxiety about the future. Unfortunately, all three major stock indices ended the week down, and the NASDAQ actually fell enough last week to be in official correction status, meaning it's lost at least 10% since its most recent high. Investors seem to be quickly losing their appetite for risk. And we saw this in more than just the major stock indices. We saw the yield on the 10-year Treasury dropping early in the week based on concerns of economic slowdown, and then climbing later in the week based on renewed concerns about inflation. We also saw the price of gold essentially flatten out, although there was a slight upward trend this week. We saw the market for Bitcoin initially drop and then climb upon word of the new Trump crypto reserve, and then fall later in the week. We also saw crude oil prices fall for the 7th week in a row, and we saw the value of the dollar fall precipitously throughout the week, most likely also being tied to the possibility of an economic downturn in the future. And wrapping up our report from last week, take a quick look at Q4 earnings. At this point in the season, focus is starting to shift to Q1 of 2025. We have about 97% of S&P 500 companies that have reported their Q4 earnings, and over 75% of those reported earnings that were better than expectations. In fact, the blended earnings growth for Q4 has come out around 18%, which is in comparison to what investors expected to be about 12% for that period. Now, what this means for us is that in the fourth quarter of 2024, companies performed relatively well, and in a lot of cases better than expected. The concern going forwards and what's affected markets recently is that a lot of the forward guidance, especially in the last few weeks, has expressed concern and pessimism about a pullback in consumer spending, anxiety about inflation, and increasing tension and indecision based on the implementation and then removal and then implementation again of tariffs. As we move forwards, in order for the stock market to feel comfortable and that risk appetite to return, there will have to be some level of increased certainty and stability that reminds investors that the trajectory of the economy can move forwards. Switching our attention to this week, the big economic reports are going to be centered around inflation and consumer sentiment. Around the middle of the week, we'll see the Consumer Price Index and the Producer Price Index for the month of February, with big questions about whether inflation will continue to fall, stagnate, or turn a corner and start to climb, which of course would be the less preferred outcome. Consumer sentiment last month showed a steep decline in consumer sentiment and growing concerns about ongoing inflation. So the preliminary report that we'll see towards the end of this week will help provide some clarity as to whether it was a one-time fear or an ongoing concern. Also this week, we'll see a couple more Q4 earnings reports trickle in. The headliners for this week are tech giants Oracle and Adobe, and retail giant Dollar General. In addition to these Q4 reports, some things that may influence the stock market following last week's tariff announcements and then pausing is that this week we have a potential group of tariffs scheduled for Friday the 14th to be put into place. But as these discussions continue and negotiations are ongoing, the big question for this week is how many tariffs will we see, and will those tariffs be paused, like so many others, until April? Turning our attention even further into the future, as always, inflation and trade wars continue to be top of mind. We've seen new tariffs being threatened. We've seen a lot of institutions and individuals voice concern with the potential harm that tariffs can cause. And we've seen a great deal of fear and uncertainty developing in the economy. Although fear and uncertainty can be enough by themselves to slow an economy down, they aren't typically enough to cause a recession. So as we move forward, the big question is, when will we start to see the impact of all of these economic changes, government employment changes, government spending changes, hit the actual economic data? While economic slowdown is a legitimate concern today, we tend to see little economic slowdowns all the time. The big question is whether a little slowdown will evolve into something much larger and much more harmful. As we move forwards, we're going to be watching the inflation data and the unemployment data much more closely than usual, looking for both trends and patterns in the data, and looking for expert analysis to try to help predict where the economy is headed. Again, if the economy experiences higher unemployment, but inflation slows, this is something policymakers can address. If the economy experiences higher inflation, but constant labor market or low unemployment, this is something policymakers can address. The situation that nobody wants to see, that we hope we don't see unfold over the next few months, is a situation where inflation and unemployment both become worse over time, and policymakers find themselves in a very difficult position. Unfortunately, policymaking in a stagflationary environment requires some very difficult choices, some very precise action, and some very calm and reassuring demeanor towards both consumers and businesses. So I can say for all of us that hopefully this isn't the environment we're in, and it won't be the environment we move into in the future. As always, we'll continue to watch the data and the reports and bring you what we think is the most helpful and the most insightful information every week. This is actually the point where we do our best work, is keeping a close eye on what's happening so that you don't have to. With that in mind, I want to thank you for joining us this week. I want to encourage you to continue to join us each week as we bring you updates on the economy and the markets and help keep you up to speed on what's happening in the financial world. Thank you again for joining us, and hope to see you next week.